program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good that you can join us again here at AusBiz as we get this new month of December underway. And let's first take a look at what happened on Friday. Global stocks rising. Little market moving news though, while a truncated session on Wall Street after Thanksgiving Day saw stocks finish higher in thin trading, with tech and retail stocks leading the gains there. For the week, the S&P 500 rose 3.75%. The Nasdaq gained almost 5%. The Dow climbing 3.2%. And for the month, the S&P and the Dow ended marginally positive, but the Nasdaq lost 1.5% over the course of November. On Friday, Intel helped lead the S&P 500 higher with a 10% gain after an analyst said the company would begin shipping Apple's lowest-end M processor as early as 2027. Nvidia was one of the worst performers on the S&P. Other notable movers included Eli Lilly, which fell, while Moderna shares jumped higher. And the silver miners surged as the metal hit a record high on rate cut hopes. The gold miners also doing well as gold moves higher. Global future markets were disrupted for several hours on Friday after CME Group, the world's largest exchange operator, suffered one of its longest outages in years, halting trading across stocks, bonds, commodities and currencies. Well, there was little data to speak of out of the US at the end of the week, while in Europe data showed Eurozone growth and inflation remain on a benign path, supporting economists' bets that no further European Central Bank rate cuts are coming in the near future. However, inflation in Germany rose to 2.6% year on year, above forecasts of 2.4%. In response, ECB President Christine Lagarde saying the interest rates we settled on at the last meetings are, in my view, set correctly. I keep saying that we're in a good position given the inflation cycle, which we've managed to get under control. Meanwhile, in China, the manufacturing PMI rose but remains in contraction of 49.2, while the non-manufacturing PMI fell into contraction. US Treasury yields rose on Friday amid low volumes after the US Thanksgiving Day holiday. The US 2-year yield rising to 3.5%, the 10-year just above 4%. Markets pricing in an 85% chance the Fed funds rate will be cut by 25 basis points at the next meeting on December 11th, with a total of 4 more cuts in the easing cycle. The US dollar index has seen its worst weekly performance since July as traders increased their bets of a Fed rate cut. The Aussie trading at 65.5 US cents. Crude futures fell marginally on Friday as investors considered oil's geopolitical risk premium amid drawn-out Russia-Ukraine peace talks. This was ahead of the meeting over the weekend of OPEC and its allies, which agreed to keep oil output levels unchanged through to the end of 2026, reaffirming their production control framework amid mounting concerns about a looming supply glut and weakening prices. Brent crude futures falling 0.8% to $62 a barrel. Copper rose more than 1.5%. Iron ore fell 1.7% to 105 US a tonne. And gold rose to a 2-week high on US rate cut expectations. Spot gold up 1.7% at around $4,230 an ounce. And Bitcoin is trading at around 91,000 US dollars. Let's get across what we're seeing on global markets at the moment. Chad Pedowitz joining us from Talara Capital. Chad, welcome back. So, as we head towards the end of this year, how would you sum up where we've been, particularly globally on equity markets?
Yeah, look, I think markets are very optimistic. I think the buy on the dip mentality has worked very well. Every sell-off has basically followed up by quite strong buying. The economic data has been broadly mixed, I think, for most of the year, but certainly not negative enough to derail the positive sentiment that's coming from specifically the AI boom and narrative. So I think where we are now is in a position of heightened broadly optimism alongside very high valuations. So I think the 2026 the earnings of the market are, pretty much have to deliver to justify where we are right now, which does create some level of risk ahead.
That said, though, Chad, I see in terms of positioning for next year, you say investors are positioned pretty much the same way they've been for the past 10 years. But is this different? You've just mentioned the AI boom, plus, of course, you've got the potential tailwinds from further rate cuts.
Yeah, look, you've got rate cuts which are priced in, and if they deliver, that might help the valuation side of the market. There probably won't be enough to materially change the earnings trajectory, which will be dependent on many other moving things. But I think the AI is a very big. It's a very big year for AI to start delivering because the capex that is being spent is quite substantial. The other growth drivers of the economy aren't really there. There's not much population growth. There's not much, certainly immigration's probably going the other way. Productivity is not that high at the moment. So you do need AI to start delivering some revenue from the large mega scalers, hyperscalers, and trillion-dollar cap companies to start showing some level of revenue growth from that side, which I think as they start to deliver or under-deliver will probably be a key driver of where the market goes next year.
Now, of course, we've seen the ongoing dominance of US equities highlighted, Chad, I guess, when you take a look at MSCI's World equity gauge there. So I see you point out 70% focused on the US essentially. So what does that mean going forward into 2026?
Yeah, well, look, so of the MSCI World, 70% is the US, which is pretty much driving the global economy in terms of market valuations. So, and those companies are predominantly on the tech space, not all, but a large part. So it does create this very high level of concentration risk for the market. Those companies, specifically the mega cap ones, in the US have to deliver and continue to deliver because failing that and having some level of a valuation adjustment, which brings down their shares, will have a disproportionately high impact on the global index just because of that high level of concentration.
Do you have concern about the US economy and its continued growth? Because I see you highlight, in fact, the working age population in the States is actually shrinking now, and you make the point that normally immigration would pick up the slack, but as we well know, the Trump administration is cracking down on immigration. So what's the likely effect then, do you see?
Yeah, well, generally economic growth is a combination of labor, capital, productivity. And if you have labor, which you've just highlighted as not really being a driving force there, and productivity, well, we just talked about AR being, there's a lot of spending there. The productivity hasn't yet come. So I think you don't have that many levers to pull in terms of the economy. You don't have a high level of, usually when they're lowering interest rates, it comes on the back of a weak economy and you've got pent up demand. You don't really have that at the moment. So we don't have a lot of tailwinds into next year unless productivity increases significantly. A lot is bet on, as we've talked about, is on the AI driven capex spend driving that, which the jury's very much out on that.
Chad, let's get to your stock you're favouring at the moment, Chubb. So that provides insurance related products. Why have you picked this one?
Yeah, well, because as I mentioned, the economy side is up in the air by where that will go, and there's a lot of optimism already there. So we do like companies that are less economically dependent. Company like Chubb, which is the largest listed property and casualty company globally, about 110 billion market cap. It has done very well. On the back of, a lot of their income comes from actually interest received on their bond portfolio. So, higher interest rates over the last few years has helped. And you can buy that on about 11 times the earnings, on about which is broadly very attractive when one considers that the market is around 22 times. Now, it usually trades at a discount because insurance companies generally do trade at a discount to the market, but that is quite a significant gap. So a high-quality company, long-term delivery, with pretty much good tailwinds, low economic sensitivity, and a good valuation.
And so you're expecting growth to continue there, because I'm sort of making that comparison with particularly the insurers here locally have been under a lot of pressure, I guess, worries about premium growth there. So what do you see then with Chubb?
Look, so Chubb are in the top end of the market, at the consumer market. They tend to be more price, they're not in the commoditized side, which some of the other insurers are. There's a lot of difference between good and bad insurance companies. So, and they are absolutely been a long-term winner. And what we're seeing there is reasonably stable pricing, alongside still prospective improvements on the income line in terms of their fixed income portfolio. And then they buy back predominantly the majority of their earnings, they buy back shares. So when you're looking at about a 9%, let's call it free cash flow equivalent yield on 11 times earnings, that's about 9%. You're broadly getting most of that back, even if the company doesn't grow.
Chad, great to get across what you're seeing there at Talara Capital. Thanks for joining us.
Welcome. Thank you. Bye-bye.
All right, let's refocus then on the local market as we get this week underway. And as I mentioned, obviously beginning December, the last month of the year, let's take a look then marginally higher on the SPI futures there. So we'll see where that trend takes us over the course of the day. We're going to do that in just a couple of minutes' time when we get across the open. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.